Today I'm going to show you how to invest in a declining market, and I'm even going to give you the secrets at the end on how to time the market. The strategy that I am talking about is called dollar cost averaging, and it can be a really effective tool, especially in a declining market, to reduce risk on your investments. So how exactly does it work? Well, say for example, we've got $50,000 that we want to invest. If we're going to implement a dollar cost averaging strategy, we're going to break that down into bite-sized pieces, which we might invest every, say, month over the course of 12 months. That's the exact scenario that I've run here. So our monthly investment is going to be $4,167, and we've actually got our money sitting in a high interest savings account, returning us 4% per annum or 0.33% per month. That I'm showing you is in a declining market where the market has declined 10% over a 12-month period. In a second, I'm going to show you another scenario of if the market was to increase in value the same amount over the same period of time. But what we can see is if we were to invest our lump sum, we'd have a final value of $45,000 because the market's lost 10%. Whereas if we take advantage of the dollar cost averaging strategy, after the 12-month period, we now have a value in that account of $48,538, which is a benefit of $3,538. Now, why is this? Well, number one, we're investing in smaller increments as the market continues to come down rather than the lump sum at the start. So we're getting a better price each and every month. This is assuming a linear decline in value over that 12-month period. But second to that, our money's still sitting in the cash account where it's achieving a 4% rate of return. But what you might be asking next is, Brendan, what happens if the market actually goes up in that 12-month period? And so I'm going to show you scenario 2 where we've got a rising market that rises by 10% over the 12-month period. So if we were to invest our $50,000 at the start, we'd have $55,000 at the end. And under the dollar cost averaging strategy, we would only have $53,129 at the end. So the difference there is $1,871. But you might actually notice that's only about half of what it would be in a declining market. So if you want to hedge your bets, if you're looking for the best strategy, dollar cost averaging, while it does have its drawdowns, can be highly beneficial in a declining market. And even if the market was to recover, the benefits of the advantages you get in a declining market, in my opinion, outweigh the disadvantages. Now, the secret of timing the market is there is no secret to timing the market. Many men have tried and failed, and I don't want you to fall into that trap. The benefits of dollar cost averaging, however, are that it reduces your timing risk. You can buy more shares when prices are low. Emotional discipline is built in, so you're not making these emotional decisions. It's better in volatile and declining markets, and you actually still benefit from the rate of return on your cash savings. Whereas if you were to invest a lump sum and the markets do grow, you're potentially maximizing your market exposure from day one. You've got all of your capital working immediately for you. It's actually simpler to execute and better, obviously, in a rising market. So those are the pros of each of the strategies. It's up to you which way you want to go, but I'm a big fan of dollar cost averaging. It's something I'm implementing for a lot of my clients, and if this is interesting to you, you want to ask me a little bit more about how it works, feel free to shoot me a DM.